Good morning. It's Tuesday, October 22nd, about 6 a.m. Central Time. Overnight, the precious metals are extending their gains after yesterday's strong start, followed by slow fade. So December gold hit a record high yesterday, 27.5540, up about 32% year to date, and then also 10% better than the S&P 500. So many of you working closely with me recognize some of those signs of caution and reduced quite a few positions. So what am I talking about? A lot of people ask me about the process when it comes to entering or exiting a market. And basically, I go through three different steps here, or three different triggers that could affect that decision on whether to enter a market or exit a position. Oftentimes, if you go through this type of process, you can front run other people getting involved with these markets. So yesterday here, we saw the dollar index go up, treasury yields go up, copper and aluminum turned negative, and equities were under pressure. The 2-year yields closed at the highest level since August, as well as the dollar index. So a lot of people trimmed off positions yesterday, but we will look with this reaffirmation of the market pressing higher, that was a short-term low, and that perhaps we could re-enter these markets for an extension upwards. So looking at the overnight price action, 27.53 on December gold. That's up $14. Low of the session, 27.33. High of the session, right about there, 27.5370. So that's up 0.5%. Silver reversing much of that reduction here from yesterday's highs of the session, and now coming back up and seamlessly matching those highs from yesterday, up about 59 cents at 34.67. That's a 1.75% gain. Copper futures up 1% at 4.40. Platinum futures up $14 at 10.31. So U.S. equities, they are under some pressure. Goldman Sachs put out this report that I think it triggered a lot of people, because they say that they believe, and this is the first line, we estimate the S&P 500 will deliver an annualized nominal total return of 3% during the next 10 years. Holy moly, that's not very good for people over the long term if that has any type of validity. I've yet to read it. It's about a 34-page report here, so that's going to take a whole bottle of wine and probably some weekend reading. Now, getting back to the markets here, we want to look at what's coming out here today. So we do have that BRICS summit underway. We have one FOMC speaker. We've got the Richmond Manufacturing Index expected minus 19 out of minus 21, and then the IMF meeting. So no real big standouts there. We don't really get things going until tomorrow when we've got the beige book. Now, if you look at the CME's Fed Watch tool, did tick down a notch. We had about a 91% chance that the Fed cuts 25 basis points, and now it's only about an 87.5%. So there were 3 Fed speakers yesterday, and it kind of seemed like they wanted to slow the pace of some of those interest rate cuts. And that's why I kind of want to put a small spotlight on the bond market. Remember the interconnection between gold, silver, and also bonds. Now, we've seen a disconnect since about 2022, but it is possible that things start to come back together and the correlations start to increase, so we'll want to monitor that as well. So the yield on the 10-year note hit 4.18%. We hit 4.20% in the overnight session. This compares with 3.62% just ahead of the Federal Reserve's September policy meeting. This is important because this is when the Fed dropped those short-term interest rates by 0.5%. At that point in time, the market was worried about slowing economic growth, and they were pricing in a terminal rate of about 3.25. Now, since then, U.S. data has been quite steady here, leaving the Fed a bit more cautious about rushing to trim those interest rate cuts. So if that starts to resurface back in the market, it could suggest that we have a shallower descent for interest rates where traders had priced in about 5 weeks ago, and it's reflected across the yields on the maturity curve. So sounds like a lot of rhetoric. What I'm saying here is that gold futures, don't be surprised if we go through one of these where we come up and then we go through a period of consolidation. Remember, we saw this market break above 2650. We shot up to 2700. We seemingly retested and traded in this range between 2650 and 2700 for several days, if not couple weeks here. We had one massive dip below it here on a reacceleration of growth, and then we are now seeing that market come back up. So we may see a new price band we just want to keep an eye on. Now, I do run a volatility model, and I make some notes on here that we have a small lower high on the gold market as far as what the possible upside range is. If you look at the silver market, it's somewhat disconnected from the gold market. That's why the gold-silver ratio is showing 79-1, and that's why we're seeing silver futures really see an influx of quite a few new participants in the market. We're seeing the algorithms, the hedge funds, the money managers, traders that normally don't get involved with that market. I've got a lot of other participants like farmers, people that speculate only in the energy markets, some of the softs. Those people are now branching in thinking there's an opportunity there. So looking at some things here, when you do, and this is part of my process on any type of market that I enter, when you establish a position for the very first time, you want to think of that position as short term. The philosophy behind that is you're able to cut your losses quickly. So you might use a smaller time frame on your scale here. So your thought process is, hey, I want to hold silver for the next few months, but the reality is that we could have a quick, decisive breakdown in that market. So you might use something like, instead of a weekly chart, you might use a daily. If you're using a daily, you might look at a 60-minute. If you're looking at a 60, you break it down to a 15. So once you find yourself in the position and you're profitable, then you risk manage that position here, and then you think longer term. So what that does is it changes the process around how you risk manage it as far as cutting your losses. Because if you look at it as a long-term trade and the market starts to go against you, what people do is they become too slow cutting their losses and too quick taking profits. So if you look at a long term, market breaks down against you, you continue to hold that position against you, and it erodes your capital. You get back to break even, you take the position off. If you think short term, you'll end up cutting those losses quite quickly, and you get that market heading in the right direction right away. Then you can risk manage and focus on the long term. So it's just a rule that I use here, and again, it's not fighting the tape here. Now back to the markets here, some critical levels of support on that gold market, 26.85. I think that's kind of my new line in the sand as far as I don't want to see that market get much below there, because chances are we'll retest that 26.50. That could be your next opportunity for entering into the markets. And we also see in the 50-day moving average 26.07, 200-day moving average a light year below that, and quite not relevant at the moment. Something that a lot of people are going to focus on, and the short-term traders is the gap that we see in silver from the Friday close to the Monday open. When you see that, or I'm sorry, the Sunday night open, when you see that, if we start to breach into that gap, you'll see a lot of people throwing in the towel, shorting the market, looking for the opportunity to fill the gap where they'll start to lift the bid again. Something a little bit cautious on this rally here in the silver is that we're not seeing markets like the copper market or really the aluminum market participating too much. Not a big deal here, just part of the checklist here, but it's much down there in the ingredients. Consider it an ingredient that's not necessarily relevant to complete the recipe. It's just something we'd like to have along with it. Call it a small garnish as some chives on some mashed potatoes or something. But looking at the oil market here, starting to turn back up. Bitcoin a little bit cautious. I think people are taking some profits there. Grain market's quite flat. Dollar index slightly lower. Australian dollar looks quite interesting to me, as it is a metals and mining type of currency out there. Might be something to consider on the upside with some options here. But you guys got any questions, give me a call. Love to talk to you a little bit more here. 312-858-7303. Remember, futures option trading does involve risk of loss. May not be suitable to all investors. Good luck. Go get them.